Monday to Friday at 12:30 p.m. only on Bloomberg Quint.
Thanks for joining us on Parlance. This is Bloomberg Quint. I'm Harsha Subramaniam. The headlines at this hour. Markets recover from morning lows led by gains in private banks and pharma stocks. Mid-cap index outperforms. Yes Bank is among the top Nifty gainers today after the board puts out a statement that it takes cognizance of all stakeholders, including the RBI, at its meeting today. Canara Bank moves NCLT against GTL Infrastructure, claims of payment of dues worth 540 crore. The Finance Minister Arun Jaitley is meeting with heads of public sector banks as part of the annual financial performance review exercise. Oil hovers around 4-year high after OPEC nations stop short of hiking production. Some traders say they expect oil to touch $100 a barrel. You are seeing some recovery on the market since morning, but yet the nervousness is quite palpable. Neeraj is here with a closer look at some of those stocks. Neeraj.
Yeah, sure. Good afternoon. So, interesting. Yesterday at close, we slipped below the 11,000 mark. The highest put open interest, and the chart will come up on your screen, the open interest distribution. The highest put open interest was at 11,000. Now, typically, 3 days to expiry, if the market were to be in a downward spiral, and if people believe that these levels would be taken out, then you would see unwinding of those positions. That didn't happen yesterday. It's not happened today. It prompted traders in yesterday's session to believe that maybe, just maybe, there is an outside chance of we closing northwards of the 11,000 mark. Now, again, too soon to judge this. It's too volatile a market to really call of whether this would happen or not. But for now, as the chart showed, 11,000 firmly there on the put side. Those put writers are fairly confident that these levels would be maintained for the current series. So just keep that at the back of your mind as you're trading, that the tallest red bar, which is the put bar, is at 11,000. If that gets taken out, by the way, the next big support is 10,800 and not 10,900. So those are the levels that you got to watch out for. Maybe northwards of 11,000. If not, then you go back all the way down to 10,800 in a very short span of time. Having said that, today the usual suspects have come back to haunt the trading screens. Indiabulls Housing, third day on a trot, down over 8%. It's down about 9.5%, 10% now. But in Friday's session, it was down 8% at close. Monday's session, it was down 8% at close. Today's session, it's down over 8% right now. Certainly seems like this weakness will stay. So that stock is having some major issues. And look at that slide, 3 days, 8% on a trot. I don't think this stock has done like this something in a while. Diwan Housing is down about 21%. Now, I'm not clubbing Ad Labs out here to this list, but that's the other one that is really cracked in trade. It's down about 15, 16%. Now, you don't quite know what will, but remember the common commentary across the weekend and on Monday morning, we said this in the trade setup as well, that there is a very high probability that in select stocks, margin pressures will come into play and these stocks will blow off. Now, I don't think that DHFL is really cracking because of fundamental reasons alone. It's done 40 to 45%, then recovered a bit in Monday's session. In today's session, down about 22%. Would lead you to believe there's some technical factors at play. This is not just pure fundamentals. Aside of the normal selling that would have happened in DHFL, I think there is some technical factors which are leading to this selling as well.
Just a word about DHFL. You heard a couple of days ago the management coming on record to say, look, there is no liquidity issue. We don't have any payments outstanding. Continuous fall of 15% plus doesn't behold confidence. Yeah,
so Care Ratings came out with rating verdict as well on DHFL paper. And yesterday the stock was doing okay, but which is what I'm saying, Asha. I think, frankly, if you heard everything the management said and everything is there visible in terms of the ratings, etc., there's little cause for concern. You would presume that these are technical factors that play out here. Somebody's position getting liquidated for whatever reason it would have been, because otherwise 45-55% falls don't happen and they don't get followed by a 22% fall again.
That's Diwan Housing for you. Neeraj, thank you so much for that. That's the stock market recovery, albeit there is nervousness yet across the board. Oil, meanwhile, is also, or trading houses are now calling $100 for the first time since 2014. OPEC and its allies are struggling to make up for US sanctions on Iran's exports. Supply crunch is pushing prices higher. In fact, Brent has already crossed that $80 to a barrel mark. Joining us to talk about what's going on, Azlan Ahmed, editor of crude oil markets at Argus Media. Azlan, thank you so much for joining us. Pleasure having you as always. What's going on? What are the pulls and pressures that's moving prices up right now?
Well, I think that we said before that the market is at the moment quite bullish just because ahead of the imposition of U.S. sanctions on Iran on 5th of November. So already we're seeing that Iranian exports of crude and condensate have been falling. So for August, Iran exports fell to about 1.8 million barrels per day, which is lower compared to the first half of the year, which was about 2.2 million barrels a day on average. So that's been the main factor that has kept prices supported. Couple that with the production issues in Venezuela and steady demand growth, those are the factors that are keeping prices up for now.
You talk to traders, Azlin. Are they talking about price levels? What would be near-term price targets that you're watching out for?
Well, I think at this point, we're not making any predictions for crude. You've mentioned the prices that some of the trading companies are forecasting. So that is their forecast, and I'm not going to comment on that. But I think that in the short term, I guess, we're now in September, over the next 6 weeks, the market could be vulnerable to the upside just because of the possibility that without any waivers from the U.S. side, companies, consuming countries, basically Japan, South Korea, China, India, may continue to reduce their Iran imports even further. So, there is spare capacity, but a lot of it is in Saudi Arabia, and if Saudi Arabia produces more, then that means that the cushion of supply capacity, spare capacity would become even smaller, and that would make the market nervous. So I think all in all, at this point, I think the market is bullish, and the market is a bit nervous about how the demand supply is going to be as we go into the peak demand period in the fourth quarter. But again, if the waivers are given by the U.S., or if countries continue to import Iranian crude, then I think there could be a ceiling on oil prices.
All right, Azlin, we'll leave it there. Thank you so much, Indy, for joining us with those details. Azlin Ahmed talking about oil prices, 81, that doesn't bode well for the Indian economy at all. But rising oil prices and spelling trouble for India's current account deficit, and the rupee, the Indian currency today, is trading under pressure as well. Take a look at where it is, at 72.80 to the dollar. That's the rupee for you. But there may be a silver lining to the rupee's fall. The currency's double-digit drop against the dollar this year is helping India's services exports, according to HSBC. Anirban Nag of Bloomberg News is here to explain to us how, well, we are actually sort of clutching at the straws to look for some good news.
That's right. You've put it very aptly. Look, what HSBC report says is that the share of services exports as a percentage of GDP has risen from 6.8 to about over 7.3. Now that's good news, especially in a time when exports overall haven't been doing all that great. They've actually lagged the global economy. As a result of the rupee weakness, what HSBC is saying is that it's actually helping the software exports, especially the services one. And that's not very surprising. If you look at the software indices, the IT index is actually up nearly 33% year to date, which has more than actually 8 times outperformed the broader BAC index. So there is a silver lining in this rupee drop that we are seeing.
I suppose a lot of money is also going towards IT because to get away from the mess that's going on in the broader banking space.
I would assume so. In the IT and the pharma sectors are doing pretty well, but IT definitely from is benefiting from the weaker rupee, it seems, whereas overall goods exports are still recovering from both the cash ban as well as the GST chaos.
Anirban, thank you so much for that. That's the IT sector benefiting from the rupee fall, the overall software exports, that is. Meanwhile, Finance Minister Arun Jaitley is meeting with the chiefs of public sector banks today. While stressed balance sheets and rising NPA will take centre stage, the government is expected to also take note of the 11 state-run lenders who've been put under the Prompt Corrective Action Framework, or the PCA framework. Nikunj Ori sums up the agenda for us. Nikunj.
Right, the finance minister is meeting heads of all public sector banks in New Delhi today, and on the agenda are a host of items ranging from credit growth, financial inclusion and recoveries made by public sector banks for all the NPAs. Remember, public sector banks recovered about 36,500 crore rupees in the first quarter of the current financial year, which was about 50% higher than the cash recoveries made in the same quarter last year. There's also going to be a presentation. The finance minister is also going to review measures taken by public sector banks to improve financial inclusion and also the steps taken by them to provide easy access of credit for MSMEs. Besides this, there's also going to be a presentation or an address by the Bank's Board Bureau Chairman, Mr. Bhanu Pratap Sharma, on leadership development, and there's also going to be an interaction with the Bank's Board Bureau post that. Over to you.
Nikunj, thank you for that. Let's move on now. NBFC stocks continue to fall despite the regulators and the finance ministry trying to assure the credit markets, and its heavyweights, I mean, they've had to bear the brunt of the sell-off that we've seen in the past few days. Shraddha is here to take us through the details. Shraddha, IL&FS may have triggered the fall, but this seems to have brought in a much needed correction in some of these NBFC valuations. That's at least one view, isn't it?
Yes, that is, Harsha. In fact, if you look at the kind of sharp corrections that we've seen, I just want to point that out. In case of housing finance companies, on the last 5 days itself, we've seen a double-digit correction for all these top 5 names. Even if you look at the other asset financing companies, the larger names like Bajaj Finance, L&T, Financial, Mahindra Finance, all of these have seen losses in excess of 20% just in the month of September, a huge 28% for L&T Finance. So the question really is that have the valuation multiples then really come down because of the kind of fall that we have seen? The answer to that is, well, not necessarily, because if you compare the current price to book multiples at which these stocks are trading and you compare them with the 5-year average price to book multiples, you will see that most of them are, or at least some of them, especially the likes of Indiabulls Housing and Dewan Housing, which actually bore the majority of the brunt of this sell-off, are actually trading at a premium despite this correction. Even if you look at some of the asset financiers like the likes of Bajaj Finance and Edelweiss still continue to trade at a premium in excess of 50%, whereas L&T Finance and Mahindra Finance, some of the CV financiers have seen some correction as far as the valuation multiples are concerned. So then what are the key or current issues as far as these NBFCs are concerned? Well, debt markets have started to turn risk averse towards NBFCs, and that has led to the belief that it will lead to a higher cost of funds for these NBFCs and hence an impact on their margins. So what analysts really have to say is that the issue here is about the higher funding costs and not really the liquidity. Also in the recent past, the share of market borrowings for these NBFCs has risen to anywhere between 45 to 60%, highlighting their dependence on these CPs and NCDs. Additionally, there's a continued strong growth that had been priced into the share prices of these NBFCs, but any sort of funding issues could imply that this the availability of funds to back this growth will not be available, or at least it will be available at higher growths. That could have a bearing on earning estimates, and that could mean that the multiples stay sluggish. So that's what we're looking at as far as NBFCs are concerned. In addition, of course, multiples had remained extremely pricey any which ways after the sharp run-up that we have seen in 2017. Now, Morgan Stanley has said that they prefer banks, especially in the rising rate environment where they have sufficient liquidity due to the deposit base. Additionally, they've also pointed out that if the growth in NBFCs were too slow, the competition in retail loans will fall, and that will only benefit these banks a lot more. Kotak has taken a contrary view, and they've said that they see lesser impact on well-run retail-focused NBFCs, and they don't see any sort of funding issues as far as NBFCs are concerned, which have a strong parentage. So they've named LIC Housing Finance, Rural Electrification Corp, even the likes of Bajaj and Mahindra Finance. They've said that the underlying business trends have continued to remain robust, especially in segments like auto finance and retail housing. Hence, they have chosen to look beyond the near-term volatility and find value. So clearly, Harsha, long-term analysts don't see too much issues as far as NBFCs are concerned, but a big funding cost increase in the near term is probably what's weighing on these shares.
Shraddha, thank you for that. Let's move on now. IL&FS, the big one, which has defaulted on 5 repayment schedules since August, has sought protection for itself and 40 group companies from the insolvency process. Menaka Doshi now joins me with more details on this one. Menaka, you've been talking to lawyers as well. We've heard the IL&FS group approach the NCLT to take some cover in terms of protection. Where does this go legally from here, and what are the options?
Okay, so let me just add a little bit more detail to the news that you've just announced. What IL&FS has just informed us via stock exchange filing is that they filed an application with the NCLT under Section 230 of the Companies Act, which is the section that looks at schemes of arrangement and compromise for itself and 40 other companies, right? Now, if you just sort of dial back a little bit and said, what were the options confronting IL&FS for a resolution route, okay? There is absolutely no specific legal framework for a company like IL&FS. And the reason why I say that is IL&FS is a core investment company which is systemically important and non-deposit taking. So in RBI parlance, it's known as a CIC-SIND. Okay? Now,
very simple.
Very simple, yes. There is no specific legal framework for a financial services firm of the nature of IL&FS. There would have been if the FRDI bill had actually been passed, because that bill actually envisaged a resolution corporation for financial firms of this nature, banks, financial firms of this nature, etc. But that bill got jammed for other reasons. So in the current legal framework, there were only 2 options. You go to the IBC or you go under the Companies Act. Under the IBC, financial services firms, there are no provisions for insolvency regulations or resolution for financial services firms. In fact, the IBC rules out financial services firms. There was one provision which said that the central government could notify a particular class of firms if it wanted to. So there was that option that if the central government wanted to say that, look, we want to make an exception for IL&FS, we're making a notification, it will get resolved under IBC. But that is not the case. The other option was to go through the scheme route under the Companies Act, which is what IL&FS seems to have picked. All very lovely for us, because just this morning we were discussing the pros and cons of using either one of these routes. IBC, like I said, they would have needed a special government notification. What the schemes route provides them with, the pros are this: a little bit more flexibility, whereby they can, within a scheme, look at raising of capital of funds, monetizing of assets, including writing down of debt. So what schemes allow, what this scheme could allow them to do is a debt restructuring of sorts.
This is under the Companies Act.
Under the Companies Act, it's Section 230 to 232, which looks at schemes of compromise and arrangement. So that's the route they've picked, because like I said, under the IBC route, they would have not technically qualified. They would have needed the government to make a special exception for them, issue a notification saying IL&FS can be done under IBC, and there is no existing framework. Also think of it this way: this is a group insolvency. This is not just the insolvency of IL&FS, because at the end of the day, IL&FS is the holding company.
Correct.
The stress is coming from underlying subsidiaries and underlying projects, and there are over 130 of them in terms of direct, indirect subsidiaries, some joint ventures, etc. So think of it as a group insolvency. They seem to have taken the Companies Act route for, like I said, the pros being that there will be flexibility, there will be ability to incorporate various different parts of a solution under a scheme.
Sure.
As they've mentioned, they're doing the scheme for themselves and 40 other group companies, so they would have identified the companies where the stress is maximum, and they would have then included them within the scheme, from what I understand. And they will now need creditor approval and or shareholder approval, and the final NCLT approval for such a scheme to go through. So we have to yet see the contours of the scheme. They have not made those available as yet. I'm sure that will take some time. But a scheme under Companies Act would need to go through approval of members, which is shareholders, creditors. If it involves debt restructuring, then you need 75% of the secured creditors to approve this. And you will obviously at the end of it all need NCLT approval. They've picked this route. There are a couple of drawbacks to this route, as experts have told us. One is that there is no explicit provision under schemes for a moratorium or a standstill. So what an insolvency proceeding allows you to do is bring a standstill to everything, right? Till you're able to figure out which parts need to get cured in what way. A scheme does not have an explicit provision for a standstill, but it does not bar a standstill either. So they can bake a standstill into the scheme and hope that the NCLT will approve that, right? That's one. Secondly, schemes could take, there is no fixed timeline for a scheme approval, as opposed to IBC, which has fixed timelines. But let's admit, IBC has has also seen all those fixed timelines getting violated at various points.
Right.
You know, schemes could take 6, 8, 9, 10 months to approve depending on the complexity of the scheme. So there is that bit of a drawback, one might say. You know, the third thing that is possibly a drawback under a scheme is that a scheme is not omnibus to the extent that it doesn't override all other laws. The IBC was drafted and crafted to override all other laws. So income tax law, etc., was all overridden when a resolution plan was accepted under the IBC. A scheme does not override all of this explicitly. So it'll be still interesting to see what the interplay of other laws is when it comes to what provisions they're attempting to undertake under the scheme. But these are some of the drawbacks versus the big plus, which is the flexibility of being able to introduce various different kinds of solutions. Also, let's remember, if you went under the IBC route, technically that's an acceptance that you're an insolvent company, which means that the shareholders are worth nothing, right? So I'm not sure in this situation LIC wants to be worth nothing or Oryx wants to be worth nothing, especially if they want to bring in, especially if they're going to bring in new funds. Capital, so in an insolvent scheme, equity shares mean nothing. You're only doing credit insolvency, right? Under a scheme of arrangement under the Companies Act, the shareholders will still retain their rights to a large extent. So I think these are some of the pros and cons of a scheme, which is why they seem to have gone down the scheme route. We need to, of course, look at the scheme in more detail once they publish that, and that will be a fairly long, big task for them to be able to come up with a scheme that covers all of this. But this is the beginning of the resolution process for IL&FS. Today was the first step that was taken, and it seems that they've picked the Company Act route. So.
Okay, we actually have a special conversation on this, on which route IL&FS could take. You can catch that at 1:30. That's with two lawyers. Yes,
no. So we have M.R. Umarji, who was a former legal advisor to the IBA and understands the resolution of financial firms, and we have Bhargavi Zaveri, who understands both IBC. And it's interesting because Bhargavi's pointed out the pros of the IBC. Mr. Umarji has pointed out the pros of the Companies Act solution. And, you know, within minutes of us having finished that discussion, we got this disclosure from IL&FS. Timeliness has been good. Good pat on the shoulders for us that within minutes they said we're going to take the company's route. So maybe they were listening in, who knows? Okay,
thank you. Well, one quick part on IL&FS as well. Part of the reason for the schedule could be another 300 crore of repayment spread across a little over a month's time. The systemically important NBFC that we've been talking about, that's how much obligation is left for IL&FS and its group entities with specific dates, works out to nearly 3 billion rupees in all. That's the timeline from now to September 30th, or maybe more, till October 24th, that IL&FS and its group entities will have to pay out to various entities. Meanwhile, Canara Bank has also filed an insolvency petition against GTL Infrastructure over an alleged default of 540 crore, 541 crore to be precise. The company has denied any such default in its exchange filing, says its dues to the bank stand at 275 crore as of 31st of March. GTL Infra has initiated legal action before, and I quote, relevant judicial authorities, and the insolvency process has been stayed pending the outcome of these proceedings. All right, did you know that there's a Tata, Birla and Mahindra Group index on the National Stock Exchange? The country's largest equity exchange started these indices in December of 2015, tracking the performance of individual group companies. Jayesh Kilnani is standing by with some details on how these indices actually work. Jayesh.
Harsha, first and foremost, these indices work like just normal, you know, how the Nifty is calculated or any other Nifty sector index is calculated, just that they are based on the full market capitalization and they have certain weightages that are assigned by the National Stock Exchange. So first and foremost, something that we did was to see how these individual indices have in fact performed over the course of this year. And what you see on the screen is the white line is the Nifty Mahindra index, the blue line is the Nifty Birla index, and the yellow line is the Nifty Tata index. Now the white and the yellow line, which is you know, the Nifty Tata index and Nifty Mahindra index, those are neck to neck in terms of performance for this year. Both of them have positive returns so far, but the blue line, you can see there's a steady slope downwards, and that has in fact given you negative return of nearly 20% so far, which belongs to the Aditya Birla camp. And there's some reason analysis that we've also done. I'll get to that in a bit, but if you have a look at at the performance of how these houses have in fact done and what kind of diversity do they have. So the first column shows you the group and the number of stocks that each of them have listed on the Nifty, or rather make part of the respective index. And of course Tata Group being the bigger one has exposure towards 8 sectors, followed by 5 for Mahindra, and the Birla Group having 4 sectors as exposure. Now, in terms of the market capitalization, now total market capitalization for the Tata Group stands in excess of 12 lakh crores, out of which nearly 2 lakh crores has been added in this year itself, largely contributed by TCS. Mahindra Group about 2.3 lakh crores. They have added about nearly 40,000 crores. This is the interesting one. If you look at it from a percentage point of view, and the Aditya Birla Group, the only one that has in fact seen some bit of shedding of market cap this year. In terms of the important stock that they have in each of them, so all groups have a Nifty company, and TCS being the largest weighted constituent for the Tata Group has a market cap in excess of 8 lakh crores, out of which 3.3 lakh crores nearly has got added in this year, and the stock has given you a positive return of 63.7%. Mahindra Group, M&M, is the largest weighted stock over there, market cap of more than 1 lakh crores, out of which 20,000 odd has been added this year with a gain of nearly 20%. Now focus on the Ultratech cement one, and this is where, or rather why Aditya Birla Group has not performed well, because one, they have high exposure towards the cement and cement product space, Ultratech being one of them. That has in fact shed about nearly 10,000 crores of market cap, and stock is down nearly 8% in trade for this year.
If you look at individual groups, group companies, Jayesh, which have been the best performers?
We looked at all 3 groups and found out what are the top 3 performers or the bottom 3 performers for each of the groups. So amongst the Tata Group, you have Nelco, which has in fact more than doubled shareholder value, followed by TCS and Tata Elxsi from the IT space. So one of the key reasons, and we know that the Nifty IT or technology as a whole has done very well this year. That's the reason that we have seen an uptick for the Tata Group as well. Moving on to the Mahindra Group, once again Tech Mahindra leads the pack over there. Once again a Nifty company, and has given you in excess of 50%, followed by Mahindra Logistics and the auto space heavyweight Mahindra and Mahindra. That has also given you positive return. But the interesting bit came in from the Birla Group. Now out of all the constituents, Harsha, that they have, Aditya Birla Fashion is the only one that has given you positive return. Remaining all have declined in trade so far this year, led by Vodafone, which is down nearly more than 60%, followed by Aditya Birla Money and Aditya Birla Capital.
Jayesh, thank you so much for that. That's comparison of the top 3 business houses from an index standpoint. Oyo, meanwhile, plans to raise about $1 billion from existing investors, including Japan's SoftBank Group, to grow its business in India, it seems. What's the company's expansion strategy? How will it, or where will the money be deployed? Nishant is standing by with all those details. Nishant.
Growth rate of...
Well, right, Harsha. So Oyo is raising about close to $1 billion in a fresh round of funding from existing investors, including the SoftBank's Vision Fund, Lightspeed Venture Partners, and Sequoia Capital. Now, the existing investors have committed, putting in about $800 million in this round, with a commitment of about $200 million. And the fund is primarily for an expansion into overseas markets, especially China, where Oyo has committed from this investment. About close to $600 million is going to go for the expansion into the Chinese market, where it set foot last November. Now, according to people privy to the development, this round values Oyo at about $5 billion. Now, besides China, Oyo has aggressively expanding outside India as well. They've expanded to Malaysia, they've expanded to Nepal and the Britain as well. The half of the money will also go deeper into the Indian market. Now, this round also makes Oyo to be the second most valuable startup in the country after Paytm, which are Oyo is now valued about $5 billion and Paytm is now valued about $10 billion.
Staggering. $5 billion is the valuation of Oyo. Nishant, thank you so much for joining us. Election candidates cannot be disqualified just because there's a charge sheet against them. That's the ruling of the Supreme Court. The Apex Court was hearing a petition on the eligibility of candidates facing criminal prosecution. The bench, however, advised some measures towards better disclosure at the stage of nomination. Arpan Chaturvedi was at the court for the ruling, has more details. Arpan.
That's right, Harsha. So the current position of law is that a candidate or a sitting member of parliament or an MLA is disqualified when there is a conviction against them in a criminal prosecution case. And in this petition, what the petitioner had sought was that this disqualification should come into effect as soon as the charges are framed or the charge sheet is filed. But the court said that that is the prerogative of the parliament, and any such law will have to come from the parliament side. However, the court did express their concern as far as the rising criminalization of politics is concerned, and on that point they have given certain guidelines, which is that as when the filing of the nomination form will happen, the candidate will have to give all the details of the ongoing or the past criminal cases against him, or the political party on whose ticket he is contesting. They will have to put up those details on their websites, as well as they will have to give publicity in forms of advertisements in the local newspapers, and this has to be done after the candidate has filed their nomination from that constituency. The newspaper advertisements will give all the details of the past and the ongoing criminal cases against any candidate. So these are some of the measures the Supreme Court laid down today while disposing of this petition, which sought that the candidate should be disqualified as soon as the charge sheet is filed against them.
Arpan, many thanks indeed for joining us. That's the view from the Supreme Court. Out of time on the show. Thank you so much for joining us on Lunch today.
Good news, got a promotion and a damn good